Welcome, everyone, and thank you for joining us for today's webinar. My name is Mary Ann Hensley. I'm the Vice President of Sponsored Content Operations here at FreightWaves, and we're excited to present this webinar in partnership with TIA. Today, we're going to be discussing how trucking freight futures can be used to manage risk. I'm happy to be joined by Tom Mallon, Vice President of Financial and Freight Futures Markets for FreightWaves, as well as Patrick Draut, Principal for Freight Futures and Risk Mitigation at K-Ratio. And they'll be discussing the opportunity that futures present, how they work, and how they can reduce exposure to spot market volatility. We'll also have a live Q&A with our speakers following the presentation, so be sure to get your questions ready for that. Before we get started, I'd like to cover just a couple of quick housekeeping items. First, if you have any issues during the webinar, please feel free to reach out to our team via the chat function in your Zoom control panel. Also, if you have questions that you would like to ask our presenters during the Q&A, just enter those through the Q&A box in your control panel, and we'll answer as many of those as we have time for during the Q&A at the conclusion of the presentations. And at this point, I'd like to go ahead and turn it over to Tom Mallon.
Thank you very much, Mary Ann, and thank you everybody for joining us today and taking time out of your busy schedules. As Mary Ann said, my name is Tom Mallon. I'm the Vice President of Financial and Freight Futures Market at FreightWaves. And just a quick background for those who don't know who FreightWaves are. We are a company that has built a world-class community in freight that uses data and technology to help market participants understand, react, and project changes in the freight market, and importantly, de-risk their exposure to volatility in the freight markets. Why are we doing this? Well, we're doing this to empower the freight community, which has traditionally struggled to deal with risks and volatility in the underlying businesses. And we do this by delivering data and analytics and insights through our SaaS-based Sonar platform, as well as our partnership with DAT and Nodal in the trucking freight futures markets. I want to talk a bit about the market and the rationale for why we're doing trucking freight futures. Before we started, our CEO, Craig Fuller, took a look at other markets that are out there that have huge underlying size, as well as critical importance to either the economy and businesses. So we took a look at markets such as crude oil, natural gas, and electricity futures. I had the benefit of being involved in both the crude oil markets as well as the Henry Hub natural gas markets during my tenure at the NYMEX. And so the crude oil market is roughly a $420 billion underlying market. It's got massive volatility. It's vitally important to the global economy. And at the time that the markets were launched, they were launched when OPEC was wielding unprecedented influence over the price of crude oil. So in the late 70s and early 80s, OPEC was influencing the price of crude oil here in the US, and futures contracts in 1983 were introduced to help the market manage that exposure to volatility and de-risk the influence of OPEC. The natural gas contracts in the early 90s were introduced because of deregulation, which took place in the natural gas industries, again, causing massive amount of volatility in a $140 billion underlying market. And then in the late 90s, electricity futures were introduced. Again, they were introduced because of deregulation that was taking place here in the US. So nearly a $400 billion market was subject to massive volatility. All these markets, very large and very important, now have risk management tools and futures where market participants exposed to volatility can de-risk themselves. So taking a look at the trucking market. The trucking market is nearly a $730 billion market, and up until March 29th of this year, there was no way for anybody exposed to volatility in trucking freight rates could manage that exposure. And so, as with all futures markets, they operate on a multiple basis. And what that means is a futures contract is traded multiple times during its life cycle. And these are monthly contracts. And in general, and being conservative, we estimate that a single futures contract in the trucking markets will trade at least 4 times, making the theoretical value of the trucking freight market roughly $3 trillion. So a massive, massive market. You put that into context with other markets. We already talked about the refined products and the natural gas markets, and also agriculture and electricity. So trucking market is, it's a massive market. It's nearly a third size larger than agriculture. And a funny story, when Craig was out talking to various exchanges in the US and talking to heads of the futures businesses at these exchanges, one of the exchanges said that the trucking market just wasn't large enough to support a futures contract. So Craig went to this slide and he pointed out to that head of the business unit, and that happened to be the agricultural business unit, and just showed this slide and said, we're sitting with, trucking is a $730 billion market. The market that you're overseeing is about $430 billion. So I think trucking might be big enough to support a futures contract. Again, looking at trucking, if you look at the vast majority of goods that are moved via surface transportation, they're physical commodities. And about 84% of these physical commodities that are moved by transportation, surface transportation, already have futures contracts listed against it. And that includes energy, agriculture, industrial metals, chemicals, and wood. So it's natural for trucking to have a vehicle where the industry can de-risk its exposure to volatility in trucking freight rates. Looking at trucking as it compares to other modes of surface transportation, trucking is the largest mode of surface transportation. It's growing slightly faster than GDP, and it's projected to grow at a faster rate than rail, than pipeline, than waterborne, than air. So again, it's a massive market. It's the most widely used of the surface transportations to move commodities here in the United States. And transportation costs, they represent about 8% of the United States' GDP. Freight is a larger component of COGS than energy in many sectors of the economy. And this is an interesting point as to why, trucking freight futures are so important. In that over the past year, roughly 40% of the S&P 500 companies have stated that freight and transportation costs are one of the most substantial risks to their earnings. So the potential for trucking freight futures to help companies mitigate that exposure is really, really important. And talking about trucking spot rates, they're highly volatile. This chart from our Sonar platform shows the DAT van rate, the national US van, as it compares to the regional, the East, the West, and the South. So you can see since 2014, there was a massive rise in freight rates to the middle of last year. But if you look at that massive rise, you can also see wild swings up and down nationally, but also regionally. So the trucking freight rate market is highly volatile. The market itself is massive. And what drives volatility? Everything drives volatility in this market, whether it be government regulations, whether it be trade policy. We're seeing the impacts of Trump's trade policies on the markets, especially last year, where there was a massive amount of freight moved to the ports in anticipation of freight rates. Weather is a huge driver of volatility, seasonality, the availability of drivers, the economy in general, consumer spending, the commodity flows. And then we'd be remiss to talk about, the market trends such as ELDs, driver availability, and what Amazon is doing day in and day out in the freight markets. All of these are causes for massive volatility in the underlying spot freight rates. So what do you need to build a liquid futures market? We talked about the underlying market, the freight market. It's large. It's highly volatile in freight rates. You need a reliable underlying price that can be used as a mechanism for settling a futures market. And so we partnered with DAT Solutions, who provide a benchmark index which is used to settle the underlying as a settlement mechanism for the futures market. We partnered with the Nodal exchange, and by Nodal, they provide a platform where the futures contracts are not only executed, but they're cleared. And what I mean by clearing is a futures contract is cleared, and what that does is it eliminates a counterparty exposure, from the transaction. And we'll talk a bit more about that when I talk about the contract specs. And then FreightWaves. So we provide the data, the analytics, the news, and the insights to the trucking freight markets. We are also the marketing arm of the tri-party arrangement between DAT, Nodal, and ourselves. So who's exposed to volatility in freight markets? Well, the freight brokers, obviously you guys, and there are a lot of freight brokers out there, 1,600 or so with $10 million or more in revenue that is exposed to volatility in freight rates. Your customers, the shippers, there's 28,000 shippers that spend more than $10 million a year on trucking freight. And then the trucking companies themselves, 4,500 or more trucking companies with 20 million in revenue that is at risk due to volatility in freight rates. And based on all of this information, we have estimated that the potential size of the spot rate market to be 40 billion miles. And what we did was we took the estimate of a $730 billion market, backed out contracted rates, backed out other modes of surface transportation, and we came up to a figure of about 40 billion miles, which if you look at the futures contract size of 1,000 miles, we estimate the underlying futures market to be 40 million futures contract. So it's a massive market with a massive amount of volatility, with no way to de-risk the market up until March 29th of this past year. Some highlights about the futures contracts. So what we did in concert with the Nodal exchange and DAT was identify lanes that could be used as a strong proxy for national freight movement. And so what we did is we took a look at the underlying freight market, and based on an analysis, we identified the most liquid lanes where futures contracts could be listed. And so the lanes that we chose represent approximately 84% of freight movement throughout the U.S. So the lanes that were selected correlate directly to 84% of all freight movement. And the lanes selected include on the west, the Seattle to Los Angeles back to Seattle. In the south, we've got LA to Dallas, Dallas back to LA. And then in the east, we have a triangle, Chicago to Atlanta, Atlanta to Philadelphia, Philadelphia back to Chicago. Those routes comprise the 7 individual lanes, And then from that, we've created 3 regional contracts. So in the West, we've got the Seattle-LA routes. In the South, we've got the LA-Dallas routes. And then in the East, we've got the triangle. And then from those three regional routes, we created a national index. So we've created 11 futures contracts, which are listed on the Nodal exchange and cleared against an index price being produced by DAT. Some highlights about the contracts. I talked about the 11 contracts which have been listed. The contract type themselves, they're monthly. They're cash settled, which means there's no physical truck involved in the settlement of these futures contracts. The indices, they're based on trucking spot rates only, so a contracted business is not included in the rate being published daily by DAT. The settlement for these contracts is daily. Positions are open and mark to market, which means they're settled on a daily basis based on either trading activity, which takes place in the market, or by an assessment that is done by the exchange as to what the price of freight should be for that day, for that given lane. The type of contract, these are dry van line haul contracts. They exclude diesel fuel pricing as well as any accessorial prices. So what you're seeing is the actual price that it takes to move a dry van, a 53-foot dry van, along the 7 identified lanes. The contract size themselves are 1,000 miles. That's the unit size. They're priced in dollars and cents per mile. And the forward curve goes out 16 months. So you can trade 16 monthly contracts forward as part of these futures contracts. And the last trading day is the last business day of the calendar month. We get asked this question a lot. What about the truck? Well, these are financially settled futures contract. There is no truck. A truck will never show up if you trade a trucking freight future. And about our partners, Bat Solutions, they are our index partner. They operate the largest truckload freight marketplace in North America. They derive their pricing from assessments and data insight from 256 million freight matches and a database with a notional underlying value of about 60 billion in trucking transactions. And the Nodal exchange, and we'll talk about the Nodal exchange in a minute. More about the contracts. What I've put up here is the futures forward curve. I've put the curve up for the national average as well as the 3 regional averages. These curves represent the forward prices for trucking freight futures going out the entire forward curve of 16 months. So in this, you can see price, you can see volatility, and you can see seasonality. And this is the forward curves for each of the 7 individual lanes that are listed on the Nodal exchange for trading. And these curves are produced daily based on activity that is placed into the Nodal trading screen for each of the 11 futures contracts. Some highlights to date. The contracts were launched and began trading on March 29th of this past year. Consistent with most futures markets, the trading volume has been thin. And for trucking freight futures, it's really been combined to the van national average contract. Bids and offers are being posted daily in the national as well as the 3 regional contracts. But more recently, we've seen activity beginning to be posted in each of the individual lanes, primarily the South and the West. Today, we currently have 6 market participants who are approved for trading on Nodal. And we also have an approved liquidity provider. That is a firm which is putting up on a daily basis bids and offers into the platform that can be executed through the Nodal trading platform. Shippers, carriers, and 3PLs are all represented on the platform today. And we are in the process of working through and creating a formal market maker program, which we anticipate will be instituted on or about October 1st. To date, the focus has been on adding new trading participants to the platform. And right now we have a pipeline of a few dozen, which are currently in the application process to join the Nodal exchange. So we're looking for the additional participants to contribute liquidity to the underlying futures market. We are embarked on a massive market educational process, and we are doing this through attendance at trucking industry events, through futures industry events, through webinars such as this, through FreightWaves events, through social media, and most importantly, individual company meetings. And the data itself is available today in Sonar, as well as on websites from Nodal and DAT. We are also in conversations with third-party market data platforms, such as Bloomberg, such as Refinitiv, such as MarketView, to add trucking freight information to those platforms for wider distribution. I want to talk a little bit about Nodal Exchange and Clearing, our exchange partner for these trucking freight futures. So the Nodal Exchange is a US-based derivative exchange. It is regulated by the Commodity Futures Trading Commission. And the exchange itself provides the venue for price discovery, credit, and risk management for participants here in the North American commodity market. Their primary market is US power. So they have on their platform electricity futures. They have also listed natural gas contracts, as well as environmental contracts. And trucking freight futures actually fits very nicely into their portfolio. Actually their contracts, these contracts actually look and operate much like their electricity contracts. In order to trade trucking freight futures, you must do two things. First, you must execute a Nodal trading participant agreement, as well as open a clearing account with one of 12 approved Nodal clearing members, and I'll talk about them in a minute. The second component of the Nodal exchange is Nodal Clear. And what Nodal Clear does is it takes out, using portfolio margining, participant risk from any transaction done on the exchange. And what I mean by that is the exchange itself actually becomes the counterparty to every transaction done on the exchange. So a buyer of a futures contract, for the buyer of a futures contract, Nodal Exchange is the seller. For a seller of a futures contract, Nodal Exchange becomes the buyer. So they eliminate counterparty risk and counterparty exposure from the futures market transactions. And here's a list of the 12 approved clearing members on the Nodal Exchange themselves. They range from the very largest, which include entities like Goldman Sachs, Morgan Stanley, and Merrill Lynch, to very focused entities such as ADM Investors, EDF Man, Macquarie Futures, and Wells Fargo. So in order to trade the futures, as I said, you need to execute the trading participant agreement with Nodal, and establish a clearing relationship, a clearing account with one of these 12 clearing entities. And how do you trade a trucking freight future? There are many ways that you can transact on the Nodal Exchange. The matching engine of the exchange is called the T7 matching engine. Nodal's parent company, Deutsche Börse, provides this electronic platform that provides for the execution. The way you get to this T7 matching engine is through the Nodal Exchange's trading platform, and that is a software platform that is provided by an entity called CQG. It is the one that integrates with the Nodal trade matching engine. Nodal also provide for a block trade mechanism whereby they have a website where trading participants can go to the Nodal Exchange, negotiate one-on-one with each other, and submit a transaction to the Nodal Exchange that will be cleared. You can also access the Nodal Exchange platform for trading through FreightWaves Sonar, our Sonar platform. We provide a direct link to the Nodal CQG trading platform. And this is an example of the trading screen provided by Nodal, and it's the vehicle that is used to enter orders into the marketplace to buy or sell trucking freight futures. And with that, I'm going to turn it over to Patrick Draut from K-Ratio, and he'll take it from here.
Thanks, Tom. 1 second here while I switch over. Thanks for the introduction, Tom, and thank you all for jumping on the webinar. Just to get some of the quick legalities out of the way, K-Ratio is a CFTC registered CTA NFA member firm. What that means is that we are legally allowed to provide advice, strategy, and trading recommendations inside of this freight futures marketplace. Over the last 6 months, we've become the trusted educational partner of FreightWaves and the Nodal Exchange, and we look forward to walking you guys through this. So let us get started here on our timeline just so that we're all on the same page. June of 2018, we have hundreds of brokers in the webinar today. Was a pretty thriving time for many brokers that that generate a lot of their profitability inside of a robust spot market. In Q4, we kind of saw the tides begin to shift. Q4 was generally not as strong as we see comparatively to the other 3 quarters. Then we moved into March where rates continued to decline, but the freight futures market opened. Since then, rates have continued to hit that 3-year low that we're experiencing right now, even during the advantageous pre-4th of July time period. And but also, we now have shippers, carriers, and 3PLs that are beginning to sign up with the Nodal Exchange, and they are saying, okay, we have just seen a very rich environment for carriers and 3PLs, and now we are seeing the exact opposite or inverse of a very rich environment for, or an advantageous environment for the shipper. As Tom alluded to a little bit earlier, there has been very light trading activity, and right now this is more of an educational process to get everybody acclimated to be able to understand how this mechanism can actually improve the cash flows inside of shippers, carriers, and 3PLs. This first slide that we're going to analyze here is a revenue slide. And so what happens when a market lowers, even if margins remain consistent, what we're going to see is a decrease in profitability. The reason being is the pie that you're pulling that margin out of is now a smaller pie. We're seeing those numbers on the aggregated brokerage revenue per load drop from $11.77 last year to $1,041 this year. From June of 2018 to June of 2019, we saw the national line haul rate fall 36% from 2010 to $1.35. So I want everybody to remember this number in their head, 75 cents, for when I provide some tables later to show the impact on cash flow savings and expenses for shippers, carriers, and 3PLs. But primarily, we're going to be focusing on the 3PL and the brokerage, considering the audience today. So what does a brokerage hedge look like? So we try to use as simple of pictures as possible so that we can really get everybody to start understanding how a financial and a real world market come together to offset risk. So right now we're in the latter part of June of 2019. We're at significantly low rates, as demonstrated by the previous slides, as probably just demonstrated by your guys' portfolio of business too as well. So what we do anticipate, and what K-ratio is believing to be the case, is that we are going to see the market rates begin to move up. There's a baseline for what a truck can run at. It's not zero, because there is always a driver cost. There are always there are insurance costs. There's the actual truck cost of the vehicle. So the baseline isn't zero. It's a lot bit higher than that. So what we're going to see is that if we are at the theoretical floor right now and rates begin to increase over time, because there's going to be some carrier insolvency that occurs, just trucks cannot afford to be running at the rates that they're at right now. John Smith is going to go back to hanging drywall or driving an Uber. He's sick of this over-the-road life that he's experiencing at the rates where they're at. It's no longer fruitful like it was for 2018. That's obviously going to create some constriction inside of capacity, which will naturally generate higher rates. So as those rates move up over the next year and a half, what a broker could do in a macro hedge, if they are exposed to spot rate volatility, is take or initiate coverage that says, when the rates are inflated, I really like the way my business profitability performs. They can take a short position here at February 2021. And this is just as an example. This is in no way, shape, or form a actual K-ratio projection of when the market is going to turn back down. However, they can initiate a short coverage and maintain that profitability for up to 16 months along the forward curve by taking short positions. Now, where does this create competitive advantage? As we could see, the two competitors who are subject to the volatility rode that wave up of profitability. However, they didn't initiate the coverage, and they are now subject to the lower shipping rates, the same cycle that everybody has been experiencing since they've been inside the industry. Additionally, I want to talk about revenue maintenance. So this is what it looks like in pictorial form, because sometimes this is hard for people to actually understand. So I want you to follow the bolder line, and that's the line haul rate. So as the line haul rates, this is for a broker that thrives in the spot world. As line haul rates increase, their brokerage profitability increases in the real world. But because they said, I'm taking a position at $1.75, they are going to ride the upswing of real world profitability, but they are going to have their account debited based on their hedging position. And essentially what it says is, broker X says, I love doing business at $1.75. I'm willing to forego some of my upside up to $2 to make sure that it doesn't go down. And then when it does go down, the 3PL would then be making less money in the real world over in this quadrant over to the right side of the x-axis. When they're making less money in the real world, they are supplementing that loss of real world financials with market gains. Now, this is just another way of looking at the preceding slide. Line haul rates go down, real world bank account goes down, futures bank account goes up to offset that real world difference. Over here we have line haul rates going up, real world bank account going up, futures bank account would be going down. Now, you sit there and say, okay, well, what is this cost of this volatility? So sometimes I can't actually materialize this. So, back when I asked you to remember that 75 cents, we're going to use some numbers that are a lot less volatile than a 75-cent movement. We're talking about a $10 million monthly portfolio that's hedged. So this would be based off of a $120 million brokerage that's fully hedged. The average futures rate per mile is $1.61. The notional value of a contract is $1,610. And that is essentially because, not essentially, that is because there's 1,000 miles inside of a contract. The notional value is the rate times the amount of miles, $1,610. The brokerage or the 3PL would need 6,200 contracts in order to cover that $10 million of business. If the rates were to decrease in 10%, the change in rate per mile would be 16 cents, and the total revenue losses avoided for broker X that initiated that coverage would be $993,000 singularly for the month of October. Likewise, November, 10 million miles, savings of $1,024,000 on a 10% movement. If we go back to that first slide, we're remembering the movement has been a lot more significant over this last 12-month time period. Now, additionally, you can sit there and say, all right, well, how can I use this tool to grow my business, or how can I use this tool to provide better service? And in this example, we call this the margin protection play. If you currently have contract freight that possibly you engaged in Q4 of 2018, and you're at the point where you're absolutely thriving right now because you're buying the truck super cheap and you still got those Q4 2018 rates for the entire 12 months, you say, you know something, I want to lock this in. You could take coverage from where you're at right now to insulate yourself from those margin compressing as line haul rates go up. Now, more importantly, this is where the service part comes into it. At this point of convergence right here, brokers, which they had to experience in parts of 2017 and 2018, come up to a very critical point inside of their business where they need to make a tough decision. Do we take a transactional loss, meaning that we have to pay the truck more than the money that we're receiving in the contract, or do we give the freight back and possibly risk our relationship with the shipper, who could be a large portion of a portfolio? So what this margin protection play allows you to do is entirely avoid that scenario through the use of a hedge. Now also, okay, let's keep talking about competitive advantage here. In this scenario, we have a bid, and what we're going to talk about here is this a line haul, a hypothetical line haul of Ontario, California to Oklahoma City, Oklahoma. That is a 99% correlated lane to a traded product that is LA to Dallas inside of the freight futures marketplace. So having a complete understanding of your portfolio and your bid process, we understand that these three companies need to make their 15%. But what they also need to do is bake in the risk of freight moving throughout the year. So these numbers are actually pulled from the DAT. So the average contract rate is at $1.87, but it's trading at $1.38. So what the broker here in the middle could do is come in at any rate under $1.87. It could come all the way down to $1.60, still get that 15% margin that the brokerage is looking for, but be undercutting these three top line competitors that are not hedging their risk in the marketplace and are essentially baking that risk into the price that they provide the shipper customer. Lastly, we envision a world that eventually we're going to get to a place, and this is a slow turn, but this is where the market's going, and this is why, as a brokerage, these are the things you need to be thinking about. Is we have a thing called Market Plus, where as a broker, you can, if enter an agreement with a shipper to sit there and say, you know something, we're done with the volatility and all of the fake trucks not being able to show up during a carrier advantageous marketplace and production lines and mini RFPs and going out to rebid. All that nonsense doesn't have to take place anymore. What we have is a marketplace that is engaging in price discovery and determining a fair price for a product to be shipped from a origin to a destination. And a broker, in theory, and when we get to this point, it's going to be fantastic, is going to be able to sit there and say, we will do it for 5% plus market. So there will be a market rate that's established on, a daily basis. However, these contracts could be daily, weekly, or monthly, where it says we are going to take the market rate and then we are just going to add our service premium or the cost of doing business or what's known as gross margin, contributing margin, or gross profit inside of a brokerage. At the end of the day, be super quick here. You're gonna have performance. You're gonna have predictable revenues and expenses. Your cash flows are going to smooth out. The risk is going to be removed as much as you are being able to hedge outside of your portfolio, and your corporate valuation is going to improve because investors and purchasers of business do not like volatility. It scares them because they don't want to enter into a unknown water when they are acquiring a company or investing in a company for that matter. So the key takeaways, everybody needs to ask themselves, how does line haul volatility affect your company's bottom line? How much of your company's risk can be hedged? And what are the next steps to participation? And that's what we're here for. We'll have some contact information. Please visit us at k-ratio.com. Reach out to us with any questions. We're more than happy to engage in a one-on-one session. Come out and visit the C-suite, and see what type of decisions need to be made from there. So I appreciate the time today, guys.
Awesome. Thanks so much to Tom and Patrick for your insights today. Tons of valuable information, and hope that all of you listening in have enjoyed the presentation. If you've not already submitted your questions for Tom and Patrick, please feel free to go ahead and send those over. We've got a couple so far, so we'll go ahead and dive into those. First question. If someone signs up today as a trading participant, how soon can they start trading? What does that process look like?
Yeah, I'll take that. To sign up to become a trading participant, you need to do two things, and they're done simultaneously. The first thing you do is you need to execute Nodal's trading participant agreement. And submit that to the Nodal exchange. And concurrent with that, you need to establish a business relationship, a clearing relationship with one of the 12 Nodal clearing banks. That process typically can take up to 4 weeks to have the know your customer and due diligence done. So if you're in the process itself could take up to 4 to 6 weeks, and you do these things concurrently, and that's what's required in order to join the Nodal exchange to be able to trade trucking freight futures.
Okay, great. And then, does Nodal guarantee a trade execution, or would one side have to wait for the other side to match up before they could move forward with that trade?
No. So Nodal guarantees performance of every transaction done on their exchange. That is the purpose of an exchange, and that is the purpose of a clearinghouse. So when you trade a futures contract and execute at an agreed to price with another trading participant on the Nodal screen, that trade is consummated. Nodal clears the trade, and essentially Nodal becomes the counterparty to every transaction done on their exchange.
All right, great. And next question. Currently, the focus is on participants acting as hedgers. Is there any interest or plan for encouraging the participation of speculators to increase liquidity in the market for freight futures?
Yeah, I mean, today the majority of the focus has been on those entities that have a physical exposure to the trucking freight markets. They are what you call physical participants. They have a real business interest, in the movement of freight rates. And then with any futures market development, typically you get those entities, those that have a commercial interest in the underlying futures market, to join the markets first. Once that happens and trading begins to form and liquidity starts to build, then you'll have those entities which are called speculators, entities that have no interest in the underlying market aside for movement in prices, and their motive is really solely to make a profit on the trade. They provide liquidity, so they are what they call speculators. And in any liquid futures contract, and by liquid I mean there are lots of available contracts for purchase or for sale. Any one purchase or sale of contracts will not move the market price significantly. That's called liquidity. And so as liquidity builds, you'll see more of the speculative interest come into the market and join those that have a commercial interest in hedging their business exposure to volatility and freight rates.
Okay, great. And next question, are there plans in the works to offer futures for more lanes?
Yeah, and I could answer that one, Tom.
Go ahead.
Yeah, and the reason that the lanes are 7 right now with the 3 aggregates and the national composite is because as we grow this marketplace, there does need to be the liquidity that kind of piggybacks off the preceding question. And in order to gain liquidity, we can't have 1,000 lanes with 1 or 2 bids and offers inside of them. So this is a strategic way, and correct me if I'm wrong, Tom, but when the market does become liquid and the demand for additional lanes does become prevalent, it's not something that is off the table by any stretch of the imagination. But more so, one of the reasons that we got into this is so that we can understand a portfolio of business for any shipper, carrier, and 3PL, kind of going back to one of my slides that Ontario, California to Oklahoma City instance. And in there's a correlation to the LA to Dallas at almost 1-for-1. So what you have is you want to be able to analyze your portfolio and be able to create those correlations. And if you would need help doing that, that's one of the offerings that K-Ratio does provide, sitting there saying, does Madison to Tallahassee line up with Chicago to Atlanta? Well, the answer is yes, but you want to know when it's lining up, and if you have to take the position off based on possibly produce season, in the late spring, early summer, that's going to occur every single year. So correlations do exist for a ton of lanes that are closely paired up, but the easiest way to think about it is if they're in certain regions, certain region to certain region with anything that's on this map that's demonstrated right now, there's going to be a decent amount of correlation, but you want to put actual numbers to that, and that's why we have that as a product offering.
Yeah, and if I could just add, one other thing to that. So the lanes selected actually, amount to approximately 23% of all freight are moving along those 7 specific lanes, which has a national correlation to about 84%. So these are highly liquid lanes with lots of freight moving along those lanes, which correlate, nationally to the overall market. And also, I think as with any market in its evolution, I do think if the market demands that you could see shorter duration futures contracts. These contracts are monthly contracts. I think, if the market demands it, you could see the potential for listing shorter dated contracts, whether they be weekly or biweekly type contracts, as opposed to, in addition to the monthly. Also, options could be created on these futures contracts as well. So we'll see how the market evolves. We'll listen to what the market participants have to say, and then we'll determine, what the best course of action is for the possibility of additional futures contracts.
Great. And so if someone wanted to purchase a contract for, say, July 2020, could they sell it at any time, or would they have to wait until the expiration?
No, you can buy or sell a futures contract at any time before expiration, so long as there's a willing counterparty in the market.
Perfect. All right. And then last question that I would open it up to both of you. In thinking about this kind of from a broker's perspective, what do you guys feel like is the biggest benefit or opportunity of engaging with futures?
Yeah, I could take that. And I'll say I believe that the biggest benefit is that you have the ability to compete with the larger brokerages. If you are a brokerage that's currently under $200 million and you have trouble competing with the big boys that will remain nameless, but we all know who they are, I encourage you to start to understand how you can win market share inside of the RFP process. But then also when the times are going good and you have the ability to remain those times and remove that volatility outside of your portfolio of business and sustainability, I think during this changing time as technology and financial products and autonomy and all of these new things come into play, this is going to be a wonderful tool and advantage for all of the mid-sized brokerages.
Great. And Tom, anything to add from you?
Yeah, no, I agree with what Pat says. I think, for, a brokerage company, I think, it does two things. Number one, it enables a broker to, I think, better service their customers, but by providing more firmness in contracts and quotes. And then, secondly, I think, it'll help brokers, to, maintain, their margins when it comes to, booking freight. So.
Great. Perfect. Well, everyone, that is all of the questions we have for today. So thank you so much for taking the time to join us and listen in as we share about futures. Thank you to our partners at TIA again, and also to Tom and Patrick for sharing your perspectives with us today. We appreciate you being here and hope you'll join us again for another webinar soon. Have a great afternoon.